So it's Saturday, May 23, 2026. And if you follow the financial markets at all, or honestly, even if you just look around your local shopping center, you've probably heard the same story over and over.
Oh, yeah. The whole, physical retail is dying narrative.
Right,
Very.
exactly. Everyone's talking about the endless march of e-commerce and how brick-and-mortar stores are just, well, inevitably declining. But right in the middle of all that gloom and doom, one company just dropped a Q1 earnings report on Thursday that, I mean, it practically shatters all of that conventional wisdom.
It really does. Looking at the raw data from this release, it forces a complete recalibration of what mature retail growth actually looks like.
Yeah, because we're not talking about some agile tech startup here.
No, not at all. This is an operation that's been running for decades, and they are posting numbers that completely defy the gravity of the current macroeconomic environment. It totally challenges that fundamental assumption that physical retail is just this zero-sum game of managed decline.
It's wild. So for this deep dive, our mission is to analyze this Q1 2026 earnings report from ROST Stores Incorporated. We're going to look way beyond the flashy top-line headlines to figure out, how an off-price clothing chain quietly generated $1 billion in pure growth in just 3 months.
$1 billion. It's staggering.
It really is. And just to set the table for you, to give you a sense of the sheer scale of the source material we're dealing with, Ross is the largest off-price apparel and home fashion chain in the U.S.
Right. Massive footprint.
Yeah, they operate 1,917 Ross Dress for Less locations across 44 states, plus D.C., Guam, Puerto Rico. And on top of that, they run 365 BD's discount stores.
And their whole core proposition to the consumer is offering, what, 20 to 70% off regular department store prices?
Every single day. So, okay, let's unpack this, because the sheer volume of physical merchandise they had to move to hit these Q1 numbers, it requires an almost unimaginable level of logistical execution.
Absolutely. The most immediate metric we have to analyze is that top-line revenue. They hit a staggering $6 billion for the first quarter.
$6 billion. Just in 3 months.
Yeah. And to put that into context, in Q1 of 2025, they reported $5.0 billion. So they basically manufactured a 21% increase in total revenue year over year.
Which is just, an additional $1 billion flowing through physical cash registers in a standard 13-week accounting period. That's insane.
It is. Moving $1 billion of additional product without massively expanding your physical footprint, that requires incredible efficiency.
Right, and the flow-through to the bottom line is arguably even more impressive than that revenue surge. Their net income reached $650 million, which is up significantly from $479 million the previous year.
Which is a huge jump.
Huge. But the metric that the institutional investors are really fixated on is the earnings per share, the EPS. They reported $2.02 per share.
Yeah, which is just a massive...
A 37% jump from last year. And it absolutely obliterated their own internal guidance. They had previously projected EPS to land somewhere between like $1.60 and $1.67.
What's fascinating here is the underlying operational metric that's actually driving that massive profitability surge. It's their comparable store sales.
Right, the comps.
Exactly. They saw a 17% increase in comparable store sales. And I just want to pause on that because a 17% increase is an astronomical figure for a business operating thousands of locations.
Oh, totally. Like in traditional retail, if you get a 3 or 4% comp increase, people are popping champagne.
Right. And keep in mind, in the exact same quarter last year, their comp sales were completely flat, 0% growth.
I'm trying to think of how to explain this, and it's kind of like, imagine you host a party in your living room every year. Opening new stores to get more sales is easy. That's just renting a second living room.
Sure.
But a 17% comp increase, that's like hosting a party in the exact same living room you had last year, but suddenly 17% more people show up, and they're all spending money.
Pushing that much more volume through the exact same physical footprint is an incredible stress test on a company's infrastructure. That's a perfect analogy because you're dealing with the same square footage, the same loading docks, the same number of point-of-sale registers, but you are processing 17% more transactions.
Right, your fixed costs are already paid for.
Exactly. It acts like an industrial engine where the fixed cost of the machine is already covered. So every extra widget you produce, or in this case, every extra shirt you sell, drops as pure profit to the floor. And that volume dynamic directly explains the massive margin expansion we saw in the report.
Oh, right, their operating margin.
Yeah, it hit 13.4% for the quarter, and their internal projections had only planned for an operating margin of 11.8 to 12.1%.
Wow, so they blew past that too.
Because when you leverage fixed infrastructure that aggressively, your baseline expenses like rent, core staffing, utilities, they're already covered by your baseline sales. Therefore, every additional dollar of revenue that comes through the door drops a significantly higher percentage of pure profit to the bottom line. It's just the purest demonstration of operational leverage operating at absolute maximum efficiency.
Okay, so the physical infrastructure is a sunk cost, which pads the net income. But, I mean, that efficiency is completely theoretical unless actual human beings show up to buy the goods, right?
No, you still need foot traffic.
Which brings us to the defining question of this entire $6 billion quarter. Why did foot traffic spike so violently this spring? Like, what happened?
Well, CEO Jim Conroy attributed this momentum to, he called it broad-based strength across the business and superb execution of their spring assortment.
Okay, corporate speak for we had good clothes.
Basically, yeah. But the source material makes a really crucial distinction here that we have to pay attention to. The primary driver of this revenue wasn't just inflation-adjusted pricing. They didn't just jack up prices. It was actual physical customer traffic. Driving distinct individuals through physical doors is still the hardest task in consumer markets.
How do they do it?
The sources outline a combination of internal initiatives and external factors. Internally, management highlighted ongoing marketing initiatives that successfully drove higher customer acquisition, paired with an improved in-store experience.
Okay, sure. Marketing cleaner stores. But what about externally?
Externally, Conroy explicitly called out a major macroeconomic catalyst. He noted that their internal modeling suggests the results benefited heavily from higher consumer spending related to tax refunds.
Okay, wait. I have to push back on that a little bit.
Huh?
I have to challenge the emphasis on this whole tax refund catalyst.
Okay, let's hear it.
The IRS issues tax refunds every single spring, right?
Yeah.
It is a highly predictable, entirely cyclical event. If the macro tailwind of tax season was basically identical to previous years, how on earth do you generate a 21% revenue jump and a 17% comp increase?
That is a very fair point.
Right. Like, you cannot simply attribute $1 billion in pure growth to the fact that consumers got their tax checks. Especially considering, like you said earlier, their comp sales were completely flat during the exact same tax season last year. If the macro environment was the same, isn't that just a temporary sugar rush? How do we know this isn't a one-hit wonder quarter? What broke in their competitors' strategies that allowed ROST to capture such a disproportionate share of those checks?
Your skepticism is totally warranted, and it actually highlights the exact difference between a macro tailwind and actual operational execution. You're right, a seasonal liquidity event like tax season doesn't magically create a 17% market outlier on its own.
Right. Everybody gets tax refunds.
Exactly. The differentiator here is the execution of their merchandise strategy. When consumers get that temporary injection of cash from a refund, they have infinite choices across the retail spectrum of where to spend it.
They could go to Macy's, they could go to Amazon.
Exactly. So Ross's ability to capture a vastly disproportionate share of those specific dollars points directly back to the other factor Conroy highlighted, their compelling merchandise assortments.
So they essentially intercepted the liquidity before the consumer could deploy it at a traditional department store or online.
Precisely. Because having a macroeconomic tailwind is effectively useless if your store shelves are stocked with the wrong product. To jump from $5 billion to $6 billion in 3 months, you have to possess the exact right brand name goods, priced correctly, and physically staged on the racks the exact moment those tax checks clear.
Timing is everything.
It strongly indicates their buying teams executed the spring merchandise transition with just incredible precision. They ensured that the off-price treasure hunt experience was highly rewarding exactly when consumer wallets were temporarily flush with cash.
Wow. Okay, so intercepting that massive wave of seasonal cash, it obviously creates a profound liquidity event for the company itself. But generating the cash is only half the battle. How management deploys that liquidity reveals what they actually believe about the company's future health.
Oh, absolutely.
Here's where it gets really interesting, because the cash flow statement and the balance sheet in this Q1 report, they depict a company that is aggressively attacking its capital structure from multiple angles simultaneously.
Yeah, the liquidity metrics are wild. They demonstrate a company generating tremendous free cash flow. Just look at the net cash provided by operating activities. It reached $836 million for the quarter alone.
Almost $1 billion in cash generated in 3 months.
Right. And looking at their overall position, they are currently sitting on $4.13 billion in cash and cash equivalents.
$4.13 billion in cash. Holding over $4 billion provides management with incredible optionality. And it looks like they are pulling almost every available financial lever.
They really are.
Like examining the shareholder returns, they repurchased 1.5 million shares of their own common stock for an aggregate price of $319 million. And simultaneously, they paid out $143.5 million in dividends.
But they aren't just distributing the windfall to investors. They are aggressively fortifying the foundation of the business. They took $500 million of that cash and used it to pay down long-term debt.
Which is huge.
It brings their total long-term debt load down to just $776 million.
It's literally like, imagine a family having a spectacular year at work, and instead of just splurging, they simultaneously pay off a massive chunk of their mortgage, right? The $500 million debt paid out. They put a ton of money in savings. That's the $4.1 billion in cash. AD, they buy an investment property, which is the stock buybacks. It's so financially aggressive.
If we connect this to the bigger picture, those dual capital allocation decisions signal a management team that is hyper-confident yet highly defensive at the same time.
Right.
Slicing $500 million off the debt load is a massive de-risking maneuver. By stripping nearly 40% of their long-term debt off the balance sheet, they drastically reduce their ongoing interest expense, which permanently improves future net income, regardless of what the sales environment looks like down the road.
But I want to push on that dual nature you mentioned. Why execute both the $500 million debt paydown and the $319 million in share repurchases simultaneously? Like, if internal models suggest their own stock is incredibly undervalued, making it the best possible investment, why not just deploy the entire $819 million into buybacks to maximize shareholder value?
Well, it requires balancing aggressive growth signaling with absolute downside protection. The debt paydown is fundamentally defensive, right? It insulates the corporate balance sheet against future macroeconomic shocks, credit crunches, or sustained high interest rate environments.
Protect the house.
Exactly. But the share repurchases are entirely offensive. They mathematically force the earnings per share higher in future quarters simply by reducing the outstanding share count. So executing both maneuvers simultaneously communicates to institutional investors that management is focused on establishing long-term structural stability just as much as they are on driving short-term EPS targets.
And that $319 million deployed for buybacks in a single quarter is just a fraction of the broader strategy. The source material notes this is part of a massive $2.55 billion two-year authorization.
Which is just a staggering amount of money to buy back your own stock.
Yeah. It puts them on track to repurchase $1.275 billion this year alone. Even after blowing past their EPS guidance and posting a 17% comp, they are aggressively buying their own stock. They are essentially purchasing their own future operating leverage.
And investing in the product, too.
Right, because the balance sheet also reveals heavy reinvestment in the physical product itself. Merchandise inventory currently sits at $2.97 billion, which is up significantly from $2.66 billion at the same point last year.
You do not tie up nearly $3 billion in physical inventory unless your internal modeling strongly suggests that this elevated foot traffic is going to persist. They are securing the brand name product now to ensure those, over 2,300 stores don't look picked over and empty heading into the critical summer shopping months.
But wait, can we scrutinize that $2.97 billion inventory position for a second?
Sure.
Because in traditional retail mechanics, having massive inventory is a double-edged sword. It guarantees you have goods to sell, obviously. But if consumer tastes suddenly shift, or if that 17% traffic spike was just a temporary anomaly like we talked about, sitting on almost $3 billion of clothing becomes a massive liability.
Oh, totally.
It costs money to store, it depreciates in desirability, and eventually it forces severe markdowns that just destroy your profit margins just to clear the racks.
Yeah, that is the classic retail trap that destroys traditional department stores. But the off-price model actually mitigates that risk through a really specific strategy known as pack-away inventory. Yeah, so when their buyers locate an incredible closeout deal on, say, brand name winter coats in March, they do not put them on the sales floor. They pack them away in massive distribution centers until the following fall.
Oh, wow.
Right. So a highly significant portion of that $2.97 billion isn't just sitting in the back rooms of individual stores waiting to go out of style. It is strategically staged capital acquired at a severe discount just waiting for the optimal seasonal moment to maximize margin.
Oh, that makes so much sense. They act almost like a commodity hedge fund, but specifically for apparel. They acquire the asset when the primary market price crashes due to seasonal timing or overproduction. They hold the asset on the balance sheet and release it when consumer demand naturally peaks.
Exactly. And that heavy inventory position aligns directly with their aggressive forward-looking guidance. With capital deployed and distribution centers heavily stocked, Ross is setting an exceptionally high bar for the rest of 2026.
Yeah, let's talk about the guidance,
For the second quarter, which represents the 13 weeks ending August 4th, they are projecting comparable store sales growth of 6 to 7%.
which is huge on top of what they just did.
Right. Projecting 6 to 7% comp growth immediately following a quarter of such extreme outperformance demonstrates they do not view Q1 as an unrepeatable anomaly. If they successfully hit that comp target, they project Q2 earnings per share to land between $1.85 and $1.93.
Which represents 19 to 24% growth over the prior year's second quarter. The compounding mathematical effect of those stacked quarters is massive.
It really is.
And due to this Q1 beat, they've actually raised their full-year guidance. They now project full-year 2026 comparable store sales to grow 6 to 7%. Crucially, that is stacked directly on top of a 5% gain they achieved in 2025.
Maintaining mid to high single-digit comp growth layered on top of previous year gains is the literal definition of aggressive market share acquisition. Oh, and full-year EPS is now modeled to land in the range of 7.52 to 7.74.
Which is just phenomenal. But parsing the mandatory forward-looking statements section of the financial report reveals the structural threats that are constantly threatening to derail this bullet train. Legal disclosures always outline the darkest possible operational timeline.
Oh, yeah, the doom and gloom section.
Exactly. They list the standard macroeconomic pressures impacting all retailers. Inflation continuing to affect consumer discretionary income, potential tariff increases on imported goods, which severely impacts apparel and home merchandise margins, and general global supply chain disruptions.
Standard stuff.
Right. There's also the mandatory flagging of cyber attacks or data breaches, targeting their transaction systems. But looking closely at the source document, there is a highly specific operational risk factor mentioned that points to the core vulnerability of their entire business model.
Which one?
It explicitly mentions their reliance on, quote, the market availability, quantity, and quality of attractive brand name merchandise at desirable discounts.
This raises an important question regarding the fundamental long-term viability of the off-price model operating at this massive scale. Because the entire ecosystem of an off-price retailer is inherently dependent on the inefficiency of the primary market.
Exactly. They are entirely reliant on premium brands making massive logistical errors. ROST doesn't design, manufacture, or control the supply of the premium athletic shoes or designer apparel that actually drive their foot traffic.
Right.
They literally acquire the mistakes.
It is the ultimate paradox of their business model. Think about it. If the broader apparel industry perfects its supply chain, if premium brands utilize advanced data analytics to perfectly predict consumer demand and manufacture the exact right amount of inventory without any overstock, late shipments, or canceled orders.
Which is what everyone is trying to do.
Right. If they do that, the off-price model loses its core product supply.
And as Ross continually expands its geographic footprint, the sheer volume of logistical mistakes they require other brands to make just grows exponentially. Like we said, they need nearly $3 billion in high-quality inventory at any given moment just to feed the machine. If premium manufacturers successfully tighten their operations to save money and produce significantly less excess inventory, doesn't Ross's supply of genuine treasure hunt merchandise simply evaporate?
It places an immense, unrelenting pressure on Ross's global buying network. They must continuously scour the global market for closeouts, packaways, and manufacturer miscalculations. Because the moment a consumer walks into a Ross store and senses that the assortment has shifted away from premium brand name discounts toward just generic, low-tier manufacturing, the psychological illusion of the treasure hunt completely breaks.
It's no longer a treasure hunt, it's just a discount store.
Exactly. And that shift in consumer perception is the quickest way to permanently reverse a 17% comparable store traffic surge.
It requires navigating a massive logistical high-wire act. They have to keep thousands of giant physical locations packed with highly desirable premium brands, yet they are entirely at the mercy of whether those specific brands accidentally overproduced the season before?
The Q1 financial results offer definitive proof that their buying teams are currently navigating that high wire flawlessly. I mean, they are capturing market share at an unprecedented rate. However, that specific risk factor remains structurally embedded in the DNA of the business, requiring constant vigilance.
So what does this all mean? When we strip away all the financial jargon, the operational leverage models, and the corporate guidance, what we were really observing is ROST stores demonstrating absolute mastery of physical retail fundamentals.
100%.
They aren't attempting to pivot into some experimental tech company or a digital ecosystem. They are relentlessly executing on off-price inventory sourcing, successfully driving physical human beings through front doors at a rate that defies broad industry trends, and converting that massive traffic into pure profit to build a practically bulletproof balance sheet boasting over $4 billion in cash.
The sheer magnitude of this quarter leaves us with a highly compelling psychological question regarding the modern American consumer, too. We are seeing definitive billion-dollar proof that shoppers remain deeply motivated by the in-person, tactile experience of discovering a premium brand at a severe discount. But if the macroeconomic pressures eventually ease and disposable income naturally rises across the board over the next few years, will these newly acquired customers seamlessly graduate back to full-price department stores?
That's a great question.
Or has the massive scale and operational success of off-price chains permanently anchored consumer psychology, fundamentally rewiring their belief about what a high-quality brand name should actually cost?
Wow. Yeah, I mean, once a shopper experiences the tangible thrill of purchasing a designer label at a 70% discount, walking into a luxury mall and paying full retail price again, it feels less like shopping and more like a mathematical error.
It really does.
Well, thank you for joining us as we unpack the massive Q1 performance from ROST stores. Keep analyzing the mechanics behind the market headlines and keep questioning the numbers.